This chart shows the Russell 1000 growth index plotted for over 3 decades, and it tells a story that investors ignore at their own risk. On one axis, you have 12-month forward PE ratio, and on the other end, you have the return on equity. Now, the PE ratio obviously is a price to earning ratio, and it's a very efficient way or that everyone and every investor should know that this is a price to earning ratios. How much money are you willing to spend for every dollars of earning? That's basically what this is. And, this is something that is used in the market all the time. So what is this actually showing you? The PE tells you what investors are willing to pay. The ROE tells you how efficiently companies are actually generating profit. And the question this chart forces us to confront is simple. Are investors pay more for less or more for more? So let's start on the left side of the chart. And in the late 1990s, as you could see, dot-com era, obviously, notice the green line. Forward P explodes to 47 times earnings. This is not optimism. This is not growth. This is speculation unheated from reality. Simple as that. Now look at the ROE. As you could see, the ROE, was elevated, yes, but nowhere near enough to justify 45 plus multiple. So what happens next? You already know the answer. Valuations collapsed. Growth stocks underperformed for over a decade. Capital was destroyed, not because companies vanished, but because prices were insane. This chart is your reminder that high growth narratives do not protect you from valuation gravity. Now, look at what happens after the bubble bursts. PE ratios compressed brutally, obviously. Forward multiples falls into the low teens. But there is the critical point most investors miss. ROE remains stable. Companies did not suddenly become bad businesses. They simply became properly priced businesses. Right? This is what's important in that green line that you're seeing. The business is still making the same amount of money. It's just that going forward, we decide to price them more. We are willing to spend more and more and more for the same dollar of earnings. So this is the market doing its job. Excess speculation washed out, survivors strengthened, returns normalized. This decade, boring, hated, ignore was a foundation for the next cycle. And that matters because it tells us something important. Valuation resets do not require economic collapse, only reality. Now, fast forward to post-2009 environment. What do you see? PE ratios begin climbing again, but this time slowly, methodically, and alongside rising ROE. So this is not 1999. This was zero interest rates, quantitative easing, massive operating leverage, software margins expanding, capital-light business models. Growth companies earned higher valuation. The market rewarded scalable platforms, high incremental margins, durable competitive advantages. For a while, valuation expansions made sense. But look what happens next. Look at the right side of the chart, the most important part. As we approach 2024 and 2025, forward PE are rising again, now near the 31 times earning. At the same time, the ROE climbs to roughly 37%. On the surface, this looks justified, but there is a catch. And this is where investors get complacent. ROE growth has flattened, right? Do you see that? Do you see the blue line flatten? Do you see the green line straight up? ROE has flattened. Valuation, however, have reignited. So, this means the market is once again paying more for the same level of profitability. This is not dramatically yet. This is not irrationality yet. But directionally, unmistakably, and history is very clear on this point. When valuation expands faster than profitability, future returns compress. This does not require a crash. It only requires time. So why is this time not different? Well, you will hear the same argument. AI justifies everything. Margins will expand forever. These companies are monopolies. Rates will fall and save valuation. But every cycle tells itself a story. What matters is not the narrative, it's the math. And the math says, 1, growth stocks are priced for near perfection. 2, ROE is already historically elevated. 3, mean reversion works slowly, then suddenly. Mean reversion is essentially the idea that ultimately everything averages out ultimately. You get back to the mean. So if ROE stalls while multiple stays high, returns suffer. If ROE falls while multiples compress, losses will accelerate. This is no scenario where valuation, doesn't matter. So this is not a bearish chart. It's disciplinary. It does not say sell everything. It says be precise. The last 30 years tells us one lesson over and over again. Growth investing works best when profitability leads valuation, not the other way around. Ignore that and you repeat 1999. Respect it and you survive what comes next. The market always forgives bad narratives. It never forgives bad pricing. Remember that. And that's why this chart is extremely important. As we are getting higher and higher in terms of, the idea that valuation is getting pricier, you need to realize this chart shows you that basically, the blue line might be, flat, but the green line is getting ahead of itself. And that is always a potential issue.